Well, hello everyone. We are back, the New American Realist. I have Don Durrett here with me today. He's a book publisher. He's also got a website, goldstocksdata.com. It's right behind him. He's also on Twitter at Don Durrett. I've been following Don for several years now. I'm a big fan. He covers mining sector. He's been in that sector for over 20 years. So without further ado, I would like to introduce to you guys. Don, how are you today?
Good, Marco. Thanks for having me on. The timing's really good.
I know we were just doing it before we hit record, like how crazy right now with all the banks, what's going on. And we talked about mining sector being in a major correction now, close to 30 months. So I'll just leave the mic to you right now to kind of tell us a little bit about what you think about this banking issue now, and where do you think the mining sector now is heading? What do you see happening? Just to cover a little bit of macro first before we get into any other details.
Yeah, it's an important story. So, gold has been, I think it's been trapped, for over 12 months. And we've been in this correction for about 30, the gold correction, about 30 months, August of 2020. And then once the selling started on Wall Street last October, not 22, but 21. So it's been over a year of selling. So once that selling started on Wall Street, I felt that gold was trapped and that it basically was not going to break out to a new all-time high, which is really all I care about. I don't care about $1,900 gold, 1950. I want it, I want it 2,100, 2,200. Because I'm a long-term investor. It's the only reason really to be in this game. And so gold's been trapped for a long time. And so we've had to be very, very patient. And we've been following, kind of what the Fed's been doing, raising these rates. And Wall Street, in my opinion, has been too bullish, kind of focusing on this soft landing. And now I think this week, and I've been saying this kind of over and over again, that we have to wait for Wall Street to kind of flip the sentiment away from the soft landing and start to basically become afraid of a hard landing. And then the Wall Street sells off. We get this capitulation selling. So since the selling began October 21, we haven't had a single high volume sell-off day, not one. So it's been kind of a steady downward movement. But Wall Street has kind of never gotten really afraid when we had this big sell-off day. I think that's still coming. And then that will be the capitulation that kind of puts a bottom in on stocks and removes the headwind for gold and silver. So I think this week could be, we're going to find out in the next couple of weeks, could be kind of, the beginning of this, this capitulation that I've been waiting for. And if that happens, I'm very bullish. Like when they're going into this year, 2023, I was more bullish ever for gold because, what I've been waiting for is a once in a generation breakout in gold where you basically get an all-time high and then it stays above that high for like 2 years. That's kind of what I'm waiting for. So we've had a couple of breakouts, we had one in 1980 and then 2011 and then recently in 2020. But they didn't last, right? They lasted a month at the high, right? And then they fell back down. Yep. So we've never really had this gold breakout that I'm expecting. And that's kind of the reasons why I invest in gold and silver, because I'm a firm believer that the Fed is using a very dangerous game of expanding debt. It's okay to expand debt, but you need to pay it back. And if you have a mindset of like a company that just keeps expanding debt, but they don't have enough income to cover that debt, eventually someone's going to come and pull the rug out from under you, and you've got a problem. So my feeling was that eventually someone's going to pull the rug under the Fed, and people say, "Well, that can't happen. The Fed can always print." Well, we're going to find out, in the next couple of years if that's the case. And I firmly believe that the Fed cannot monetize, say, 75, 80%. So this year, the federal government is projecting, $1.5 to $2 trillion deficit. Biden came out, his number was 1.8, but of course that's just, that's his number, and who knows what's going to happen. But I think it's probably going to be at least 1.5, and it could be as much as 2. So if the Fed historically, the Fed hasn't had to monetize that money because foreigners and private investors would buy up the debt, because we never had a problem. Now the foreigners are kind of staying away. The two biggest buyers is China and Japan, and they've been net sellers recently. Those are two biggest buyers. So if the Fed has to monetize 75-80%, it's just a matter of time before everybody basically says, whoa, I don't want to buy those bonds. The Fed's monetizing them all. They got a problem there. There's a problem that's building, right? And that's when I say the rug gets pulled, and we get some type of monetary reset, which I think is going to happen around 2027, not anytime soon, but 2026, 2027 is my expectation of this. That's when the Fed basically can no longer, monetize all this debt. It just basically, what I just explained is going to unfold. So all that stuff is kind of percolating in the background, and the Fed, in my opinion, is going to, I don't know if this is too strong a word, but lose control. So historically, the Fed has always been able to do whatever they wanted. The lower rates, inject money. They never had, any semblance of somebody telling them that they can't do something, or the market's telling them they can't do something. Well, we're now approaching that. We're approaching the point in time where the Fed can't do what they want because of inflation. And what I mean by can't do what they want, they can't take rates to zero, because that would create a big, inflationary problem. Basically negative interest rates, huge negative interest rates, right? They can't do that. And then they can't print money, do QE to infinity at this time, because that would create more inflation. So you see what I mean? They're kind of getting trapped here. And so in the background, I've been watching this and been talking about it for months now, about what's looming, and Wall Street is keeping the S&P at 4,000. I'm going, that is just, in my opinion, is just way overvalued, because if we are going into a recession, those earnings aren't going to be able to hold up. Like, we're already like 18. The PE on the S&P is like 18 right now. Historically, that's high. So if it was at 16, it would be a lot better, which is, I think where we're going, 16, 15, 14. So my target on the S&P is at least 3,300. So the new low would be 3,500. But if you get a new low, I think this is the final. I mean, if you look at the chart, whenever you get these sell-offs, they tend to go up and down, up and down. We've had this is going to be the fifth sell-off that we've had since October of 21. And so I think this fifth one's going to be deeper than the other ones, right? So if you get a new low at 3,500, that means it's got to go, lower than 3,500, right? So if it only goes to like 3,450 or 3,400, that's not much of a new low. That's not really a capitulation sell-off for me. I think we got to go at least to 33. And I actually think we're going to 3,200, but I'm giving that target of 3,000 to 3,300. And if we don't get there, after this week, it now looks more likely to happen. But, if we don't get there, I'm going to be very surprised. It's because all the data points that I look at, I look holistically at everything, and I look at, and I use history as a backdrop, exactly what the Fed has done historically, what the U.S. economy, global economy has done historically. And everything seems to point to, a new low, and a new low much lower than 3,500. That's what it's pointing to. It's like, it's amazing how many people in the last, say, month, because January and February were stable. So it gave people a lot of confidence. It's amazing how many people were saying that the lows are in. I heard many, many analysts say the lows are in on the S&P. We don't have to worry about that anymore. And then everybody was talking about, heck, 2 days ago, it was 80% likelihood that the Fed was going to raise 50 basis points. 2 days ago. That's how much it flipped in 2 days. And now everybody was going, no. And so I was saying, no, it's going to be 25. And this is going to be the last raise they do. I might have, once we got closer to the 22nd, if things remain stable, I didn't expect them to be. I expected March to be a very volatile month. as we got closer to the 22nd, if it would have stayed at 80%, I might have flipped and said, okay, yeah, I'm thinking this is going to be 50. But as of yesterday, and I mean, as of 2 days ago, I still thought it'd be 25 because of all these headwinds that I see coming. I don't see this as a kind of a rosy scenario. We go into a soft landing and then the economy gets back on its feet. I don't think people realize how much damage COVID did to the economy. It did significant damage. The economy just doesn't get back on its feet that easily. It's going to take some years for some of that damage to come back. For instance, all those small businesses that went out of business, banks aren't making loans to make them whole again. So you got a lot of damage that was done there. A lot of people didn't go back to work yet. That's another one. Do we get people to go back to work? Is that, do we get the participation rate? That's not easily done either. That doesn't flip a switch and that happens. So a lot of headwinds that were already there in the economy. And I think we're heading into a recession here. And when the recession comes, it's not going to be easy for the Fed to basically restart the economy like they did in 2009. 2009, they lowered rates and they injected money and they restarted the economy. This time, it's not going to be as easy. Those are my comments.
Yeah, you really answered, because my next question would have been, I think it's very important about what do you think about the next Fed meeting when it comes to rate hikes? I'm on the same boat with you on that. I've been talking about that for a while, that I believe that they're just going to pivot a lot quicker than most people think. I thought from 75 going back to 50 was in a way a pivot, because the real rates were still higher as they were for the federal fund rate being at the percentage that they were going. And if you look, even the number that the Federal Reserve, the government, the Congress, whatever we can call them, as one unit in a way, as a unit, they looking at it as federal funds rate now, it's at 4%. We're doing good. We're getting closer now to 5. We're going to, without any problems, going to 6. And their inflation was right around, what is the last CPI reading? Did it come around 6? Was that 6.5% for the CPI? Or it was a little higher than that? Do you remember?
I think it was 6. Yeah, I think it was 6.4.
So that's so you're looking at, so let's say 6.4% for the CPI number that came out. And we know it's way higher, but we don't have to go into details on that. We know it's higher, but let's say it is 6.4 and the federal funds rate is, let's circle it at 5. We're still in the negative real rates. So why would the Federal Reserve go in from 75 to 50 and then to 25 basis points now, as they hiked the last month was 25, correct? And to me, that looks like a pivot, because you could not even get the rates higher, and the real rates are still, lower than the federal funds rate. So it's just a total banana republic to me. So I agree with you. I think they're done after this one, but obviously we could be wrong.
Right. I've been calling that. I think they're going to cut rates in the third quarter. Now that's dependent upon if the GDP basically goes negative in the third quarter. If GDP goes negative in the third quarter, then I expect them to lower rates. And because once GDP goes negative, I think you're going to see a lot of mass layoffs, and you're going to see a lot of people screaming, that you can't let the economy just go into a ditch. You got to give it some help. You got to give it some support. You just keep rates here. For instance, they're going to raise rates to 5% here in March 22nd. You take rates to 5 and you just leave them there, and the economy is basically hemorrhaging and mass layoffs are happening left and right. I just don't see politically how they can get away with that. So that's why I expect them to cut in the third quarter, dependent upon GDP going negative. So my expectation the whole time, one final thought on that, the whole time was that the Fed would raise rates until they couldn't. And the thing that makes it what could happen, when they couldn't. And one of them is a liquidity event, which we had this week. That's all that. So we're already there to where they have to stop raising, right? Liquidity event is one. GDP basically going negative is another one. and then just some type of, black swan event that maybe isn't a liquidity event, but probably any black swan event is going to be a liquidity event, credit event.
So many of
So
those
I
that can
can't
happen
go.
any moment now, right? So many of black swan
Yeah,
events that can happen any moment now. That's for sure.
yeah, yeah, absolutely.
So
Yeah.
when you're looking at this is all good for gold. Is that accurate statement? When you look at the lower interest rates, as we both think are coming again, even with the pause as the Fed stops after this meeting because of all these liquidity issues with the banking, this is all positive for gold, which brings us to the next question, which is your definitely your
Right.
expertise when it comes to the mining sector. How do you see
Right.
this play out then?
So, yeah. So about, is this good for gold? Everything we've talked about so far on the show. So my perspective on gold is the only reason why you own gold, there's two reasons to own it. One is you're basically wealthy and you just want to hold an asset that's going to hold its value. But I don't think of gold. You can say three ways. One, yeah, you're wealthy, you just want to hold it. Another one was you're basically not, wealthy per se, but you want to own a little bit of gold as kind of a hedge, a little insurance policy. I always say this, it's good to have 50 ounces of gold, 1,000 ounces of silver as kind of a hedge per se. There's that. But the other one for me is speculating on mining stocks. So that's kind of where my focus is on my website, of course. And so on mining stocks, for me, the only thing that really, it's such a high risk sector that you shouldn't even be messing around with it unless you're a speculator. And every stock, every miner that you buy, you should treat it kind of like crypto, thinking in terms of it's going to go to zero. And thinking in terms of it's going to go underwater. It's a very highly risky thing. So from that perspective, if you're going to invest in something that's highly risky, then you want a high reward. So if you want a high reward, for me, the only thing that makes sense, the only way you're going to get high rewards is if gold and silver prices go up substantially. And we're not talking about gold go up $100. That's nothing. Even $200. But it's amazing how many people kind of like to invest for the near term, like for the next year. I'm going to invest in a gold miner. I'm going to get a 25% return because gold's going to go up $100. For me, I just think that that's not a good way to invest. For me, I don't care about the near term. Like people today were tweeting to me, Don, my miners didn't do anything today. I'm like, don't focus about the near term. Always focus about where gold and silver is going to go. And look at your stocks when gold gets to above 2,000, above 2050. These are my breakout numbers. Above 2050 on silver, above 30 on silver, 2050 on gold. Wait till they get above those breakout numbers, then look at your stocks and see how they're doing.
Because usually
don't worry. Don't worry.
Yep, go ahead. Sorry.
Yeah, you got it. But the thing about these mining stocks is that you need much big breakouts in gold and silver to make a lot of money. And my feeling is that that's going to happen. That's the only reason that I'm in it, because I have belief that we're going to have these higher gold and silver prices. And I'm very bullish. And so what's going to drive that? What's going to get gold to 2,500? I mean, if we don't get to 2,500, as far as I'm concerned, I'm not going to win, put it that way. 2,500 to 3,000. I'm hoping for $3,000 gold and then a GSR of 30, gold silver ratio of 30, which takes silver to 100. So you got 3,000 gold, 100 silver. And I think those numbers are, if they don't get hit, then we'll get really close, 2,800 gold, 75 silver, something like that, right? And it's very, very possible that we exceed my targets, but I think we'll get close to them. So if we get close to them, the miners, make absolute sense if we do hit those numbers, because the miners are going to, really explode here. I mean, if you do some work, read my book and see why miners have that kind of leverage. And key, of course, there's tons of risk for each individual stock, of course. So I always invest, and I talk about this in my book, with low allocations, because each miner is a speculation bet. So, keep your allocations very low so you don't get hurt on any individual stock. It's amazing how many companies will put 10% of their cost basis in a single stock, or sometimes even 20, right? It's incredible how people will gamble because they want the high return, the quick high return, right? You got to be patient and wait for gold and silver to do what I think they're going to do. We're not really talking about why gold and silver are going to explode higher, but what it really comes down to is one word, two words actually: systemic risk. So the only reason why people sell their stocks and bonds and fiat, those three things are what investors like to go to, when they get, defensive. So you go to utility stocks, for instance, on stocks, or you go to, U.S. Treasuries, short term, or you go to cash, right? Those are the three things you go to. You don't necessarily go to gold unless you're nervous about your stocks and bonds and fiats losing value. And my feeling is that we are approaching a point in time where those three investments all increase in risk. They no longer have their historical levels of risk, because this is a topic that's too big for this interview, but it's about, the U.S. era basically coming hegemonic global control, or controls might not the wrong word, but influence coming to an end, or beginning to come to an end. And so that's when all the risk levels start going up for stocks, bonds, and US dollars. People want to hold more gold, not just the retail crowd, but even your pensions, your insurance, your hedge funds, your 1% crowd, they want to hold gold. And that's why gold goes to 3,000. For me, it's all about systemic risk and pushing people into gold, not because they necessarily want to, but because they necessarily feel like they have to.
I just wanted to real quickly, I did not want to forget to ask you this question. Going back at the beginning of our interview, you mentioned the word reset, 2027, 2026, 2027. Did you think, did you mean that resets is basically the dollar will completely implode? Is that what you were implying to when you mentioned the word reset for 2027?
Yeah, it's a good question. No, I do not think it will completely implode, but what I do think will happen is whenever you get some type of a monetary reset, you get a revaluation. So what I think they're going to do, again, this is just hypothetical, guessing on my part, is I think they're going to orphan all the euro dollars. So all the dollars that are outside of the US are going to be orphaned. They're not going to be allowed into the United States. They're basically, the US is going to come up with a new currency, and it's probably going to be a digital currency. And they'll release that new currency, and they'll force all Americans to convert their money into the new currency. And the old US dollars will no longer be used in the United States. So they'll effectively orphan the euro dollars. And that will prevent inflation, because now foreign banks will not be able to create dollars or hypothecate dollars and increase the dollars, because those dollars can come back to the US, and that's what they want to prevent, because we'll have an inflationary problem. So if we have an inflationary problem, we want to orphan all those dollars, and that's the easy way to do it. And when they do that, the new dollar, I think, will devalue the existing dollar. And I think it's going to be devalued anywhere from 25 to say 40%. Although 40% seems unlikely, but 25% to me seems very, very possible. Devaluing currencies actually is very beneficial for the country as a whole, but it's not beneficial for those that are not affluent. If you're affluent, you can take the hit, right? 20%, no problem. But if you don't have any money, it can be a little painful. But the way they'll think about it as the country as a whole, because now our currency is worth less, and now we can export. It's easier for us to export goods because our currency is worth, we just devalued 20% against the euro, for instance. And so it makes sense to devalue. And so that it's a perfect opportunity, for them to solve a ton of problems all at once by doing this reset. I think the U.S. dollar, the central bank digital currency, the CBDC, I think it will come out well before the reset, but they won't force it upon people, right? It'll be kind of a slow rollout. They'll just get it out there so it's there for when they're ready to do the reset. So they're going to get it all prepped to get it working, get people using it, and then when they do the reset, they'll force everybody into it. That's what I see on happening. But again, I'm just guessing, right? I could be completely wrong here. It's just hypothetical.
No, that's great.
What's going to happen.
I'm glad I asked you for the reset because, as you know, there is so many different ideas and theses on the reset, and that's why I'm so glad that you explained that for our viewers to get a better idea. What is your outlook on reset? That's I thought very important. And with that being said, I do want to thank you for coming down on the show today. I'd like to post some of your books in the description of this video. So I will chat with you after I stop recording, and I will have all those posted down. And again, this is Don Durrett for goldstocksdata.com.
All right. Yeah, on the book, just do the gold stock, just do my gold book, right? And anybody that owns a gold mining or silver mining stock should read my book. I just did the 9th edition. It just came out in February. So it's all nice and fresh. And anybody that's thinking about possibly buying a gold mining stock, you could read it as well.
Well, thank you so much, Don. I really, really appreciate your time. I will talk to you soon, I hope. And when you get down to Arkansas, let me know. We're going to meet up.
Will do.
Sure.
All
Take
right,
care,
thanks.
and we will talk soon. Bye-bye.
All right. Bye.